Good morning from London. I'm Anna Edwards alongside Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. The White House looks to dial down trade concerns, saying Presidents Trump and Xi will talk soon. There's US praise for the EU coming to the table, but Europe warns again about possible retaliation. Higher stimulus hopes help push Chinese stocks higher despite a private sector factory gauge falling to its worst reading since 2022. Plus, Poland's Prime Minister Donald Tusk looks to shore up support for his coalition with a vote of confidence after his candidate for president lost out.
Well, good morning, Anna. Checking in on these markets, and we are waiting for Xi to pick up the phone to Trump or vice versa. But in the meantime, stocks are tired of the uncertainty. You're looking at futures pointing lower stateside, pretty flat here in Europe. A bit of a recovery for the dollar today, so euro dollar down to a 114 handle. And we had the 30-year Treasury yield actually poking past that 5% level yesterday amid all of this tariff uncertainty. 4.93% is where we are at the moment, though. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. It is Tuesday, the 3rd of June. Once again, we have plenty of trade lines to focus on. We also need to factor in the latest data out of China and some of the politics in Europe. But Lizzy, let's unashamedly return to the trade theme, because that does seem to be where the market's focus is right now. And it's not giving us necessarily a very clear signal around risk appetite, because US futures equities point a little lower, but oil prices going higher. So not getting a sense that perhaps this is driving sentiment in the moment. But we're waiting really for some word out of China on whether Presidents Trump and Xi will actually meet, because the spokesperson for the White House says they will, but we haven't heard from China yet.
Yeah, ever since that Geneva truce, it seems both sides have just got annoyed at each other, right? So you've got the Chinese student visa issue, you've got the chip design software restrictions, AI chip export guidelines as well. But on the US side, they're annoyed about the critical minerals and the exports of those not being ramped up enough, according to Donald Trump, for all these cutting-edge electronics. So, as I say, the US wants Trump and Xi to get on the phone, but Beijing not looking like they're really into the idea at the moment.
Yeah, waiting for some confirmation as to whether that's possible. But certainly the signals from the White House are that this could happen at the end of this week. Meanwhile, what's Europe doing? We have had slightly more positive signals from the White House about how much they appreciate that Europe has come to the table, negotiating in good faith, they say. But Europe has been responding to the 50% tariff threat on steel and aluminium, and said that this is undermining the wider trade talks, and once again they reserve the right to retaliate, put further tariffs on certain products or new tariffs if they don't manage to get to some sort of resolution by the middle of July. Yeah,
because the EU wants to fast-track these talks before July the 9th. Perhaps they're feeling grateful that they didn't rush into a settlement with Trump like the UK, perhaps you might say, did, now that we've seen the steel and aluminium tariffs. Because if you were the UK, you would be annoyed right now that that trade pact is undermined by the steel and aluminium tariffs. And Trump doesn't have the time now, when he's got all of this court battle going on, to renegotiate your deal and maybe give you an exemption on the 50% levy. So, yeah, there is this European negotiation happening at the same time. And Macron and Maloney meeting in Rome today, because they've got to try and present a united front, not just on Ukraine, but also on trade. Now, when it comes to the China story, if we can go back to that, I think a key question is who's got the upper hand here. And we had some interesting data out this morning from China that shows really it's an ugly picture, at least for Chinese manufacturing.
Right, and at least for a specific part of Chinese manufacturing that the Shein index picks up on, because as we've said many times, Lizzy, you know, the composition of this index is not the same as the official PMI. It's much more small, medium size, it's much more private enterprise, it's quite export orientated, and all of that is, you know, sets it up to be weaker than the sort of official PMI data. So Bloomberg Economics saying, is this a Shein misfire? Is this data giving us a little bit of a sort of duff steer as to where the overall Chinese economy is going?
Look, this is despite the trade truce. That's what's worrying about these numbers. And John Authors makes an interesting point this morning that, you know, the financial markets can rage about taco. Does Trump always chicken out? But if you're a business dealing with Trump's trade policy, you've got to take it seriously. Yes. And that's what we're seeing in the market.
And you make an important point about the survey period here, because the survey for this was the 12th to the 21st of May. When was the Geneva truce when did that take place? That was the 12th of May. So that entire period of positive, more positive at least, relationship between China and the US should have been picked up here. Now, maybe that's far too soon for businesses to just sort of pivot on a dime, as you suggest, and in the way that markets can. But certainly something that we continue to watch. So that's where we are on China. Lots to think about when it comes to China, and also Chinese assets getting a boost then, because people immediately go, well, will we get stimulus?
Well, that stimulus, maybe that should come in the form of trade talks. Get on the phone, and then you could maybe alleviate some of this.
Right, so we'll see whether those talks do come to the fore, do take place. Let's pivot to some European politics then, Lizzy. We've got news out of Poland. Of course, no doubt you gave plenty of coverage to the results of the Polish election yesterday, but the sort of second-order effects of that. Now we have Prime Minister Donald Tusk calling for a confidence vote in his coalition. He wants to shore up the coalition because we see a continuation in some ways of the situation that has existed in Warsaw, where they have a president from a different party, but this new president from a different party comes in with even more perhaps explicit support from Donald Trump and that sort of that conservative nationalist bent, and with a renewed mandate, I suppose, in terms of what he's going to stand in the way of, and that's what the Prime Minister is concerned about.
Yeah, and there's a lot of anger from the coalition partners of Donald Tusk, saying that this is just unnecessary theatrics, that he should be calling this confidence vote. Notably, it isn't a snap election. He'd said that he wasn't going to do that even if Nawrocki won, because the regular ones come in 2027. But still, of course, as you say, this is Tusk trying to shore up his position here, because the fact that the MAGA candidate has won in this presidential election is not good for Tusk's pro-EU agenda, and it's not good for the pro-Ukraine agenda either.
Yes, and just briefly on Ukraine, we did see some progress in the fact that Ukraine and Russia in Turkey, in those conversations, managed to get to some kind of agreement on prisoner swaps, and there was that achievement, but really it fell short of many. If anybody had expectations, there would be some kind of truce. It fell short of those expectations, and Russia's demands certainly seem extensive still coming into this, asking Ukraine to give up 4 regions that it essentially still owns, and asking Ukraine not to accept foreign intelligence and to demobilise its troops. So huge demands on Ukraine coming from Russia.
Well, yeah, Turkey's Erdogan suggesting that they need another meeting now between Putin, Zelensky and Trump. But Zelensky kind of saying even if you got that meeting, it still wouldn't lead to a lasting ceasefire, because ultimately, Putin just isn't ready to end this war.
Shall we go to another corporate story then, Lizzy? Just breaking on the Bloomberg terminal, the long saga around Thames Water. Yeah,
Thames Water saying that KKR will not proceed with the equity raise process. KKR's preferred partner status has now lapsed. Thames Water is going to progress talks on the senior creditors plan, and Thames Water saying that KKR will not be in a position to proceed. So this is very interesting, given all of the nightmares that have been going on with Thames Water. Of course, the headache for the UK government that all of this has been creating.
Yes, is this coming a little earlier than expected? Some of our more recent reporting was expecting some of this to run through the month of June, so we'll continue to watch this story. Let us tell you what is coming up on the show. We have a great lineup of guests to talk about trade, talk about investment strategy, to talk about defence, and much in between. Kellyanne Shaw, Akin Partners, joins us, has served with the previous Trump administration, so a really important voice to listen to on trade. Ludovic Subran at Allianz joins us, now CIO over at Allianz, so we'll get his perspective on trade, on defence opportunities and much beyond. Georges Debas is with us, BNP Paribas European Equity Derivative Strategy Head, and Hobie Bouvat, Deutsche Bank's co-head of capital markets EMEA. Lots to talk about there when it comes to leverage finance, Lizzy. We haven't seen perhaps as much M&A and IPO activity taking place, and sometimes there is that link, of course, between that capital markets activity and the debt raising, and so what does the outlook look like?
And then we have a lot on the docket, of course, for the economics and politics as well. So let me take you through that. At 10 a.m. London time, we get the euro area CPI numbers ahead, of course, of the ECB meeting in Frankfurt on Thursday. The expectation being that inflation hits 2% for the first time in 7 months, so setting up a cut on Thursday. Then, as we say, we've got Macron and Meloni meeting in Rome to try and present a more united front between France and Italy when it comes to Ukraine and trade. Then at 3 p.m. London time, we have lots of data coming out of the US, durable goods and factory orders, as well as the US JOLTS data as well. And I heard Tom McKenzie saying this earlier. I think it's a really important point, Anna. We're not expecting that much of a drop in the job openings in these numbers, even though they're for April, when, of course, the tariff rhetoric was absolutely absolutely at fever pitch. But what you could see is that there are fewer job vacancies than unemployed people for the first time in 4 years.
OK, well, that'll be an interesting milestone to witness, especially coming as it does in the same week we get non-farm payrolls, and that'll be on Friday. The expectation there is we drop down from 177,000 on jobs created to 130,000. So the effect of Doge, the effect of, well, is it Microsoft, Disney, all the other job cuts we've been talking about of late, we will be watching to see if we get any of that showing up in the macro data, because it's been kind of absent up to now. Really interesting to watch the Meloni and Macron meeting in Rome. They've got lots to talk about. Trade, no doubt, will be on the agenda, trying to find much more common ground perhaps on that, on Ukraine, on the Middle East, and this coming ahead of a NATO meeting and G7 meetings which continue.
Yeah, because it's significant even that they're in the same room, because Meloni was absent from that Albania meeting last month, and there was, as I say, this split when it came to the Ukraine position. So perhaps that the priority over the trade story in this meeting in Rome.
OK, here are some of the other stories that you need to focus on this morning. Microsoft has cut hundreds more jobs just weeks after its largest layoff in years. More than 300 employees were told their positions had been eliminated on Monday, according to a Washington state notice reviewed by Bloomberg. A Microsoft spokesperson said the latest headcount reduction is in addition to the 6,000 job cuts announced last month. Taiwan Semiconductor Manufacturing, or TSMC, says it sees profits rising to a record high this year. The company's CEO says he expects to see steady growth in 2025, adding that its technology will remain secure amid global expansion. And the ruling coalition in the Netherlands has failed to reach an agreement on the far-right Freedom Party's migration plans. The proposals introduced by party leader Geert Wilders include a temporary halt to family reunification and closing borders to asylum seekers. Wilders has threatened to quit the coalition if a majority of his party's proposals aren't adopted. Talks are set to continue later today.
Well, coming up, we've got a packed programme. The UK Prime Minister looking to reassert the country's defence capabilities amid all of these heightened geopolitical tensions on the European continent. So we're going to dig into the details of those plans and where the money will come from. Plus, Chinese e-commerce giants Temu and Shein are finding it difficult to divert focus to Europe, with the US markets still being their main driver. So we'll bring you that story as well. But up next, Washington signals more trade talks, but do markets expect a dialing down of tensions? We'll discuss. If you've got any questions of your own for our guests, please do send them to us on IB+BBTV Go. This is Bloomberg.
Welcome back. This is the opening trade. 16 minutes past 7 here in London. So 45 or so minutes until the start of equity trading. And the futures picture looks slightly positive for Europe, factoring in a little bit of late in the day optimism in the US session. But US futures, equity futures, point a little lower. So we bear that in mind. Now to Treasuries. 30-year Treasuries are again testing the 5% level as concerns persist over Donald Trump's trade war. Let's get more from Bloomberg's Valerie Teitel. Good morning, Valerie.
Good morning, Anna. Yeah, Treasuries are stabilizing. Yesterday, though, was a pretty brutal session. We did see those 30-year yields breaching 5%. They poked above it just briefly, Anna, but we're back below it as well. Also, the 530s curve yesterday neared 100 basis points, which is still near the steepest level for this Treasury curve since 2021. But we're stabilizing today mostly due to a strong JGB auction. There was a 10-year auction that took place in Japan a few hours ago, came through really strong. Remember, it was a very weak 20-year JGB auction, which really ignited global fixed income weakness. We do have some more tests of demand coming. We also have a 30-year JGB auction on Thursday, and then next week we get 10s and 30-year supply from the U.S. Treasury. So that'll be very interesting to watch for how there really is demand for these yields at this higher level. So Treasuries are stabilizing. We're also seeing stabilization in the U.S. dollar. The Bloomberg Dollar Spot Index is trading stronger today, up nearly 0.2%. This is after yesterday's session saw it close at the lows year to date and the lows since 2023. We can flip on and just look at the U.S. dollar a bit longer term. Take a look at how much this year has really pummeled the U.S. dollar. We're down 8% from those January highs and really nearing the lows of 2023. If we breach those, we have to go all the way back nearly to 2021 to find those lows similar for the U.S. dollar. So the momentum is really on the back foot for the U.S. dollar, but we are stabilizing today.
OK, Valerie, thank you very much. Bloomberg's Valerie Seitel with the latest on Treasuries and FX markets. Now, where does the latest on the trade narrative leave Donald Trump, President Trump's trade policy? Let's talk about that with Kellyanne Shaw, partner at Aiken and a former deputy assistant to the President for International Economic Affairs during Donald Trump's first term. Kellyanne, nice to have you with us here in London. Welcome to the set here in London. So the latest news lines around trade suggest that markets are really waiting to see whether we get a meeting confirmed between President Trump and President Xi. We've heard from the Chinese Foreign Ministry. They say they have no information to share on whether this is going to take place or not. So we'll wait for any confirmation of that. What difference could that make? Knowing a little about the relationship, perhaps, between the two, or witnessing it in the first term, what difference can it make when these two actually speak to each other?
Yeah, well, thanks so much for having me back on. And what I would say is the U.S.-China relationship with President Trump and President Xi at the helm is a very dramatic and mercurial relationship. But the way that this worked during Trump 1.0 is that sometimes you would see key negotiators and some of the key figures in the administration bring deals to their respective leaders, and then the leaders would have a call. But oftentimes it worked the opposite way, where it actually took a leader-level call to try to break through some of the ice. And so that's what you're seeing the White House tease right now, is the fact that we need a call between Trump and Xi to deal with some of these export control issues, the fact that China is still not making good on its Geneva agreement. China will have its set of requests and demands as well, including U.S. export control. So it's really teeing up an interesting conversation. But it is not unusual to have the leader-level call go first before progress.
Yes, so we'll see whether we get this call and whether we then see any progress delivered. What is your base case assumption then, Kellyanne, as to where we land on some kind of measure of trade tariffs into the United States? We've seen the legal challenges. I know you were on with the team last week talking about the various options, the various tools that the U.S. administration can still use to try and get its policies enacted. Are you managing to boil that down to a number, say, I don't know, low teens, mid-teens percentage tariff on U.S. imports? What's your expectation?
Yeah, and what's been interesting is if you watch the Sunday shows, you had multiple U.S. administration officials out there saying, look, there's this court case, but it actually won't matter. Either they say we're going to win the case, or even if we don't, we have an entire toolkit full of potential tariffs that we can use. So what I'm telling clients and what I'm advising is don't expect these tariff rates to change. The fact that we have this 10% across the board baseline tariff, the president has other tools he can use to impose that, and then potentially raising tariffs on trading partners who don't want to negotiate. He's got other tools to do that, too. So I don't really think that this changes the chessboard. What it does change is a bit of the timing as this litigation plays out.
So does that mean, then, we still get, what is it, 10% average tariff, 15? What's the ballpark?
Yeah, that's where we are right now. And the president has said that he can use 122, 301, 232, and other types of legal authorities to reimpose some of these same 10% tariffs.
But where we've seen, Kellyanne, this doubling of the steel and aluminium tariffs, does that make you think that the UK was a little premature in agreeing this trade pact with the president?
Well, I think where the UK is actually coming out probably better than any other trading partner right now is those steel and aluminum tariffs were part of that trade deal. So the U.S., although we didn't have much detail in terms of what was agreed, there was an agreement on steel and aluminum that certain UK products would be exempt, provided that they adopt similar measures as the U.S. And so the UK is actually in a much better position than other governments who don't have those commitments. Now, what I do think this means is that steel and aluminum are going to feature as a very prominent part of some of these other trade negotiations, like with the EU, Japan, Vietnam, and others who are currently negotiating.
Well, yeah, so when it comes to the EU deal, how quickly do you think that they can get that over the line? Or are there other lower-hanging fruit that you think will come first?
Yeah, I'm not optimistic, and I never have been, about a U.S.-EU trade deal, in part because some of the blocks that have existed in the past continue to exist about two entrenched regulatory systems that really don't see eye to eye on a number of issues. Now, that said, they're making a run at it, and the president is turning up the heat to try to get the EU to come to the table. But I think countries like India, Japan, and South Korea will be first before we see anything with the EU.
Yeah, so it might take some time to get there. I mean, what expectation is there, really, do you think, in Washington that Europe or any other jurisdiction changes its VAT regime as a result of a request from the Trump administration?
Yeah, well, so far we've seen very little interest from our trading partners in adjusting some of their taxation policies. But what's been interesting is that part of the big tax discussion happening in Washington is this concept of a revenge tax, the Section 899. And that is designed to get at the digital services taxes that a number of our trading partners continue to impose on U.S. tech companies. So that is looking like a potential pathway for the U.S. to go after some of these tax issues, but it doesn't look like the VAT is really going to be part of these negotiations. It could be that the administration has other tools that it plans to execute.
But Kellyanne, Valerie was just showing us how you've got long-end yields rising in the U.S. Are you not worried that if you have Section 899, it's going to drive away that foreign investment even more?
Yeah, that's certainly a concern, right? Because it has to do with whether or not companies and individuals are going to be investing in the U.S. There's also a question about Treasuries, whether they're included. I think there are a lot of questions about this legislation. And what's not clear is whether the Senate takes it up as part of its big, beautiful tax bill as well. So we don't actually know if this is going to become law. But it is certainly a messaging tool that the administration is using to try to say, look, we haven't forgotten about digital services taxes, and we have some tools there.
Yes, I mean, and the digital services tax suggestion from the United States is that these taxes are extraterritorial. But then a lot of what we're hearing in terms of policy coming out of the White House would seem extraterritorial. I mean, from sanctions regimes around Russia to some of what we're talking about here with 899 of the big, beautiful bill. Does this just need a whole new reset across the Atlantic? It seems that there are just so many areas of disagreement and a lack of consensus.
There are certainly no shortage of challenges in terms of this economic relationship. What I would say is the view from the United States on a relatively bipartisan basis for the last 20 years has been that our trading relationships are asymmetric, that the deal that was cut back in the 90s just doesn't work and it's not fair in terms of today's economy. That's going to take updates and changes. Now, where the line is in terms of is the U.S. Being too aggressive in terms of responding to some of these asymmetries, I think that's for the two trading partners to work out. But clearly there's going to be some changes if the president's going to land something that is more equivalent.
Yeah, I mean, there would have been a choice to... another U.S. administration could perhaps have teamed up with allies and said, let's try and reinvent the global trading system so it suits all of us a little better because it's maybe skewed too much in China's favour. But that's not an approach that the Trump administration felt it wanted to take.
Well, what I would say is I spent 10 years as a U.S. negotiator working for different administrations, and other administrations have tried to use more traditional forms of diplomacy and negotiation, and it just hasn't worked. And even in Trump 1.0, you had this trilateral deal between the EU, Japan, and the U.S. to try to get at some of China's unfair trade practices. It took 2 years to negotiate, and they couldn't even agree on a common definition of subsidies. It's not a particularly effective way to reorder the global trading system. Now, is Trump's? We'll have to see. But certainly traditional methods just don't work.
And given that you know Trump's mind so well, you can settle something for us. Does Trump always chicken out?
Well, I think he would take a great issue with that characterization.
He didn't like it.
Nasty, you said.
Yeah, but I mean, here's the thing, too, right? Like, if this idea of chickening out means that we have 30% tariffs across the board on all Chinese imports and 10% on everything else, I'm not sure I would describe that as chickening out. That is a de-acceleration from a trade embargo, which was just unsustainable.
OK, always good to get your insights. Kellyanne Shaw, Akin partner, we really appreciate you coming to join us in the studio. Now, coming up on the programme, few signs of trade deal breakthroughs with either China or Europe amid all these tariff threats. We're going to discuss the market impact next with the Allianz CIO, Ludovic Subran. Stay with us for that conversation. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes until that opening trade, that equity market open here in Europe. And the futures picture suggesting we'll see a little bit of upside perhaps at the start of trade. But we bear in mind that we see weakness in some China-related assets as a result of the data out of China. So iron ore prices and the like a little weaker. That could weigh on some of the mining names. Energy, we do see further gains in oil prices, so that could be an upside. But more into the future, US futures pointing a little bit lower. We have seen a bit more stability returning to Treasuries, as we heard from Valerie Teitel. fell after the 30-year yield went above that 5% mark yesterday. But we have a little bit more stability courtesy of Japan and its decent 10-year bond auction. As a result, we see a little bit of movement at the 10-year horizon on these European bonds. 3 basis points, though, not too much of a move then, Lizzy.
Well, let's stay in Europe and turn to the politics. The Polish Prime Minister Donald Tusk says that he is going to seek a vote of confidence. That's after the candidate backed by his party was defeated in Sunday's presidential election. Tusk spoke about the election's outcome.
Over 20 million Poles elected a new president of the Republic of Poland, showing their strong commitment to democracy and its key principle, free and universal elections. No matter how we judge the winning candidate, we should recognize his victory and congratulate his voters, which I hereby do. I also thank the loser for his determination and fighting for every vote to the end.
Well, Oliver Crook joins us now to talk about the latest. Ollie, do you think that Donald Tusk is playing with fire with this confidence vote?
He certainly doesn't think he is. This is why he's calling this confidence vote. He's hoping that this is going to be able to demonstrate that there's still support for his coalition government, for his cabinet, for his agenda, broadly speaking, despite the defeat of his ally and the preferred candidate in the election over the weekend, we should say, who only lost by about 90 basis points. This is an election that was decided by less than 1 percentage point, but it's that less than 1 percentage point, Lizzy, that will basically dictate whether Donald Tusk was able to get his liberalizing agenda through and basically versus guaranteeing deadlock within the Polish political system, in which the president has a great deal of veto authority, in addition to having key roles like appointing the central bank governor, which has caused tension in the past between the finance ministry and the accusations of politicized monetary policy. And that is basically the fate that Donald Tusk is now staring down, having real difficulty trying to get his agenda through. So his next steps are going to be to call a confidence vote to demonstrate that his government still has a mandate. He will likely then also reshuffle the government, but he's also alluding to basically a plan B that he has to put in place, that he are prepared for the situation. And he's vowed that despite the outcome of the presidential election, they're not going to take a single step back, though it is hard to see how he's going to be able to take any steps forward, because, again, there is a lot of power within the president within Poland, and that law and justice candidate is likely going to block many of his initiatives.
Meanwhile, Ollie, with a view to European politics, we see migration and asylum policy getting a lot of attention. I know Friedrich Merz, where you are, has had trouble with some of the policies he's been trying to enact. And now the ruling coalition in the Netherlands risks collapse after failing to reach an agreement on migration. So what are the dynamics there?
So once again, in the Netherlands, we have migration basically threatening to bring down the government. This is exactly what happened just less than a year ago when we got this new government. It is a government that the largest coalition is the Freedom Party, that is led by Geert Wilders, anti-Islam, anti-sort of immigration, wants to put a lot of restrictions. And what Geert Wilders has done is basically put an ultimatum to the government within the Netherlands. He has put forward a 10-point plan on migration. He says that if the majority of those 10 points are not adopted by the parliament, he will pull the plug on the government and bring it down. He said yesterday that he's going to sleep on basically what he's going to do. So those negotiations will continue a little bit later today. Just to give you a flavor of what some of these policies are within the 10-point plan, he wants to use the military to guard and secure the land borders of the Netherlands. He wants to turn away all asylum seekers. He wants a temporary halt on family reunification. And he wants to send Syrians back to Syria, which he judges is now a safe place for people to return. Whether or not he will pull the plug, he threatened to do so, by the way, in February, a little bit earlier. But again, this shows us some of the political instability that we're suffering here across Europe, with the Netherlands as the last example.
Thanks very much, Oliver Crook, there with the latest on some of those political threads across Europe, and Europe really trying to get itself on the same page when it comes to global trade conversations as well then, Lizzy.
Yeah, the President Donald Trump eager to land more trade deals, but talks with Europe and with China as well continuing to languish amid all of these communications breakdowns and the fresh tariff threats as well. Let's think about the market impact now. We have Ludovic Subran, who is the CIO of Allianz. Good to have you with us back on the programme, Ludovic. I mean, as we've seen in the market reaction, the dollar's been battered, but really it's quite surprising perhaps that stocks in the US have rebounded since the so-called Liberation Day. So I'm wondering who's going to meet whom first. Is it that equities are going to fall to match the dollar, or that the resilience in the US economy lifts the dollar?
It's a very good question, and I think it's very hard to have an answer right now because the dollar is a very politically loaded segment of the market as we speak. So if you believe fair value models, like I tend to do every other day, I think the euro dollar could land around 1.12, 1.13, which is basically where it is today. If you believe Donald Trump, there is still room for another 15% devaluation of the dollar. And he's ready to do whatever it takes to make sure that the dollar goes down again so that he can rebuild the manufacturing of the US. And so investors across the globe are watching that space very closely. So there is indeed this tension now on the direction of the dollar, and there are a lot of people looking for hedges. Hedging against, further depreciation of the dollar is now, I think, the biggest trade in the market, trying to find cheap hedge, trying to find efficient hedge. And this is something that has been unfolding over the past 4 months and is not going anywhere. Then you asked about equity. It's very interesting to me because I think this disconnect between the equity and the bond market is something that we've seen in the past. I would say when you look at the corporate credit market, which is also a good indicator, it actually confirms the strength of the companies that are on the stock market. So there is really maybe a moment where people trust more big investment-grade companies than they trust the government of the United States, which is something I've barely seen in the past, maybe in Argentina or Greece during crisis time, maybe also, during the 2010, 2009 section in the US, right? So this is also very surprising, and this is something that cannot hold. So these two disconnects, so on the tension on the dollar direction, and indeed this disconnect between the bond and the equity market, or more generally between corporates and governments, is something that is indeed really, about whatever is happening on trade, on the future of the currency, on the future of the fiscal sustainability of the US, and also on the future of alliances, especially on defense and on a global provision of common goods like security and so forth.
Yeah, and I want to pick up on all of those themes, but let's start with what you just said about Trump being willing to do whatever it takes, because that seems to be the opposite of Trump always chickens out. And I wonder, is there a level when it comes to the S&P or to Treasury yields that you think precipitates the Trump policy put, as so many others have faith that it does?
Well, in the past 5 months, I think we've seen a form of disciplining by the market, especially the bond market. So there is one thing that's still to hold the fort, which is indeed the bond market. So when we see the 10-year US reaching around 5%, I think this is something that is creating a bit of stress. When we see liquidity squeeze in the bid to ask spreads, in the issuance of the US Treasury, this is also something that I think gets Donald Trump a call by Jamie Dimon and others. And so that seems to be, I think, the ultimate guardrail against, some of these policies. And so, but what people need to understand is that it is really eroding a lot of the trust on its way, right? So you have to go really far. It's like the Overton window in communication politics, right? You have to go each time a bit further into dislocating markets so that there is a pulling out in terms of, some of the more radical policies. And this is something that is testing fires. This is playing with fires, and this is something that is testing and stress testing the system. So there is indeed a bit of a last, adult in town, which is the bond market. But the question is now, bond market are also asking for more, especially on how much are you ready to lend to the United States government when you have 7 or 8% deficit looming ahead with the big, beautiful bill, right?
Yes.
So even that market is going to prove to be extremely complicated in the coming months.
Okay, with that in mind, Ludovic, let me ask you a couple of things about the big, beautiful bill and the things that come from it. Section 899 getting a lot of attention, and this is sometimes called the retaliatory tax on foreign investors and increasing the cost, basically, of foreign investors buying US assets. Are you factoring that into your assumptions at Allianz, Ludovic, and are you therefore going to buy fewer US assets as a result of 899 if it comes to pass?
Look, 899 is for me exactly what people don't spend enough time on. Everybody's looking at trade, which is the tip of the iceberg, but there is below this momentum around capital controls in the US in different forms. And one of the forms is indeed this increased tax rate for foreign corporations operating in the US, and more generally, frictions, frothy, capital flows between the US and the rest of the world. I don't think markets are pricing in today a full implementation on Section 899. So that could actually spook markets vividly because a lot of people, I talked about the hedge being the name in town today, but a lot of people are also looking at cross-border exposure at large. So beyond hedges, when you're a European investor, you look again at, okay, there is the dollar depreciation. There is indeed, yields in the US are a bit under duress, and and there is this additional taxation, would you go long-term in the US? And when you are President Trump and the whole policy continuum is about making sure that people do long-term investment in the US, do you really want to spoil that party? So I think the market has to say that he's going to withdraw on this, because that could actually completely annihilate what he's trying to do on, his policy agenda. But if he were to move on with that policy, I think that could create a big scary moment, especially on the equity market and also again on the bond market. And so that is not factored in today because a lot of investors are not thinking that it could go through as it is, explained today in the bill.
Okay, so if that does add up to a big scary moment, Ludovic, what would pricing in that big scary moment look like? A sell-off in stocks, you suggested, but how high for yields and how weak for the dollar?
I think Section 899, we're talking about a sell-off around 10%, yields that could go up around half a point, and then the dollar that could go down another 5%. So it's quite huge.
Ludovic, I want to turn to your report on defence funding, if I may. We also had the UK's strategic defence review coming out yesterday, but a reluctance from the UK Prime Minister Keir Starmer to guarantee that he is going to spend 3% of GDP on defence in the coming years. I wonder, as you look ahead to the autumn budget from the Chancellor Rachel Reeves, does she need to commit to raising taxes in order to fund defence spending?
Well, this is the biggest discussion we've been having. When President Macron came to television, I think it was March 5th, 2025, to tell us we're at war with Russia, without any announcement. But at the end of this television speech, he did say, and we will not raise taxes. And so that was the big economic announcement, right? And so basically this idea that we can go to war without raising taxes is somehow, the assumptions that we have here in France. When you look at history, you usually need three things to go to war. A third of your issuance or defense spend, you have to, raise taxes. A third, you have to substitute expenditures, and a third, you go to debt, right? This idea that we can go to war and that we increase, our defense spending to 3% without raising taxes, I think is not possible. So this is indeed a big question mark for the UK. I think the headroom, the space that exists, the fiscal space in the UK is very limited. It was around 10 billion pounds over the past few months. And this is something that is really, a major issue for this government. So I think it would be a very hard sell for Chancellor of the Exchequer to go and say we're going to raise taxes for funding peace or war, the name you call it. So I don't think this is feasible. So that means that's going to, again, be one of these governments that are going to say that we can go to war without increasing taxes. And this is going to be extremely nefarious, I would say, for the bond market in the UK. And again, for the bond market in Europe generally, because there is no plan for funding this war. And this is very costly. Yes,
nothing that we have talked about, Ludovic, sounds like lower yields anywhere. I mean, at least in the US or Europe. Would that be the correct conclusion?
This is the exactly correct conclusion. I think last week we wrote something on the return of the term premium. I'm very worried about real rates increasing across the globe, from Japan to the UK to the US to Europe. This is really a moment where people are getting a lot of distrust into the ability of governments to fund the multi-injunction they're trying to fund at a time where the economy is in such a situation of tension. So yes, indeed, rates are increasing across the globe.
Okay, Ludovic, thank you very much. Ludovic Soubrun, Ellehaus CIO, thank you very much for joining us. Coming up on the programme, today's stocks to watch, we take a look at miners after China's manufacturing activity unexpectedly contracted in the month of May. That was thanks to or reported by the private sector Shein index. We will get further details on the stocks that we're watching this morning. That's next. This is Bloomberg. Welcome back. 7:48 here in London. This is the opening trade for Tuesday, the 3rd of June. And European stocks suggest we'll be a little bit higher at the start of trade. A little bit of late in the day optimism on Wall Street, perhaps yet to filter through into European markets. But US futures do point a little bit lower. Let's talk about the markets in 3 minutes. Bloomberg cross-asset strategist Ven Ram joins us now. And Ven, I actually want to start with the dynamics we've seen overnight and what they mean globally in the bond markets. Over in Japan in particular, we saw an auction there, which, unlike last week's, which caused a lot of concern and had people scrambling and asking questions about long-end yields, today's auction in Japan seems to be a little calmer, and that calmness seems to have spilt over into Treasuries a little bit. What was your assessment?
Morning, Anna. Absolutely spot on. I'm not surprised that the 10-year auction in JGB sailed through, because it's not a debt per se that investors are averse to. I think what they are averse to is touching debt at the longer end of the curve, the 30-year part, the 40-year part. And we are in a milieu where the 30-year Treasury yield is around 5%. So investors are beginning to ask questions that, look, how long can this story of fiscal profligacy go on unchecked and unpunished? And that is what the message investors is sending out, that message. Now, if you look at last week's 40-year auction in JGBs, that went through at close to 315. And so investors are basically asking the question, what is the opportunity cost for me to invest in JGBs at just 315, when 30 years from now, will that principal that is redeemed to me hold its inflation-adjusted value intact? And that sentiment is spilling over everywhere, across Treasuries, across German bonds even. Now, the interesting dichotomy in all this, Anna, is that, if you look at German 30-year bonds, they're yielding north of 3%. And, if you'll have to go back to the Eurozone financial crisis, Eurozone debt crisis, to see those levels, because we haven't done those levels in a long time. So investors are tarring German bonds as though they were smeared with the same brush as JGBs and Treasuries, which is not quite the right thing, because even with the debt brake scrapped in Germany, Germany's fiscal rectitude is as good as it gets. And if you hedge the currency yield on the exposure to the euro, you will get 550 on the German 30-year yield. Nowhere are you going to get a yield as high as that with sterling credit as Germany. So I think that there is an opportunity here for German bonds to shine in the long term.
OK. And Ben, I just want to pick up on something that we were talking about with Ludovic Subran just before you, which is this divergence between the dollar and the US equity markets' fortunes since so-called Liberation Day. Actually, today, we're seeing a bit of a recovery for the dollar and euro-dollar weaker. What do you make of that?
Well, I think it's nascent, but I don't think it's got legs, because we are in an environment where the U.S. economic weakness data is going to show up in the data in the coming months, and I think that will put the Federal Reserve on the back foot. They will want to rescue. At the moment, they have been agnostic between the inflation mandates and the unemployment mandate. But come weak data, they will quickly pivot to the rescuing the economy, which means that they will cut rates and real rates will go down. And that will put the dollar on the back foot. And that means good fortunes for the pound and the euro.
OK, Bloomberg M Live strategist, cross-asset strategist, Ven Ram, we thank you. And don't forget, you can get all of the analysis and insight from Ven and the team by going to MLIV Go on your terminal. Let's go from the macro to the micro. Joe Easton from our equities team is with us for the stocks to watch. Joe.
Morning, Lizzy. So we're going to be watching the miners today after a pretty significant reaction to that data out of China. Take a look at the copper futures, down around 2.5% in the US exchanges. And also we did see drop down in iron ore as well. So potentially we're going to see weakness in some of the basic materials stocks, which have already underperformed this year, as we can see from this chart. The orange line there being the basic resources index. Significant underperformance versus the broader market, given we have had had concerns around the economy and China specifically weighing on those. One of the stocks, though, that I've had my eye on recently is Glencore, given this is really one of the most favourite stocks among analysts across the entire UK market at the moment. 18 buys on that one, but some of those might be disappointed with that data out today. Then we've got Prosus on the radar. The Chief Investment Officer, Irvin Tu, standing down. Now, he's been at the company for around 4 years, and we can see that this stock has pretty much underperformed the broader market over that time. However, a lot of that is due to weakness in tech in general, although some of their assets, including some of the food delivery stocks, really underperformed after the pandemic. So potentially a bit of a refresh at the investment firm could be a positive for that stock, which trades over in Amsterdam. Keep an eye on Prosus. Then finally, UBS. It's a big week for that one because we've got a decision coming up on the capital issue over in Switzerland. We're going to get a decision on that on Friday. And today, Jefferies upgrading the stock to buy, saying that they think it will be a positive turning point when we get that ruling on how much capital the bank has to keep on its books. That one is upgraded at Jefferies. Potentially, we're going to see it trimming some of that underperformance. Keep an eye on UBS in Switzerland.
Joe, thank you. Equities reporter Joe Easton, of course. I'll add another to the mix then, Lizzie. We've got MJ Gleeson, which is not a huge house builder in the UK, but topical because they are warning this morning about profitability. The stock could drop at the open, and one of the reasons they give is planning delays, and that has been seen as something of a priority for the government to get through those.
Yeah, definitely for Angela Rayner, the Deputy Prime Minister, and reporting that she is one of the ministers, I think it's 4 ministers, who are really angling to get funding secured by the Chancellor before the spending review. But she's one of the last to settle. So is that money going to come through? The uncertainty not good for the likes of MG Gleeson. Also keeping an eye on the defence stocks this morning. Outperformance for DAX futures. Rheinmetall looking to be up in Tradegate. Is that going to hold when we get into the session? We're coming up to the opening trade. Stay with us. This is Bloomberg.
Welcome back to the programme. A few minutes then until the opening trade. Let's cast our minds back to yesterday's trading session, and particularly into the US and the closing hours of the US session, and see if that teaches us anything about where we go here in Europe this morning. We've got the US here in the blue, and you can see that we did see some positivity towards the end of the session, and that could be still captured in European trading today. So we are perhaps expecting ourselves to go a little bit higher with that in mind, but US futures are pointing lower. If we can show the futures picture, US futures pointing lower. European stocks, though, could be going high, as I mentioned, as a result of playing a little bit of catch-up. Not a huge amount of corporate news flow surrounding earnings, certainly, but we'll certainly be keeping our eye on some of the sectors that Lizzie's going to go through in just a moment. More broadly, Treasury markets, bond markets, Lizzie, seem a little bit calmer than they have been of late, and perhaps that's a positive signal for stocks. But what are the individual companies and sectors that we're watching for today?
Well, I want to pick up on that DAX futures outperformance that you've just shown, Anna, because we are minding the defence stocks this morning. We saw outperformance yesterday off the back of the UK Strategic Defence Review. Maybe it's a bit of a hangover from that. But we're also seeing Rheinmetall up on Tradegate. Is it the opposite of the peace dividend? Because, of course, the Istanbul talks towards a Ukraine peace deal didn't go so well yesterday. We also keep an eye on the miners this morning. We've seen base metals falling after the China Caixin data, manufacturing activity falling to its lowest level in more than 2 years in this private survey. So keep an eye on the likes of Glencore. And finally, Prosus, their Chief Investment Officer, stepping down. So we keep an eye on those shares in Amsterdam as we head towards the open, Anna. OK, so some individual sectors and companies to watch out for. Yeah, really interesting what's going on with the mining sector. Over in the Chinese session, in the Asian session, we saw actually Hong Kong and Chinese markets going higher on expectations of stimulus. That doesn't necessarily translate, though, into higher commodity prices. So let's have a look at what the European Open has for us this morning. Waiting to see a little bit of positivity on the board this morning, although it could be short-lived given what we know that the
US futures are suggesting. So FTSE 100 futures up by 0.1% out of the gates first this morning. Not a huge amount of news flow then, Lizzy, that we're dealing with in terms of European corporates. Stock 600 up by 0.1%. Yesterday's dynamic was pretty interesting. A number of stories over the weekend throwing markets around a little bit. We saw weakness coming through in steel. We saw strength coming through in defence. We saw energy stocks going higher as a result of higher oil prices. But those themes, we've left some of those behind, and some of them continue to move into these markets, I suppose. Defence being one of those. So broadly higher across these European markets seems to be the way to summarise it this morning, Lizzy. What do you see deeper down?
Yeah, let's look at the sectoral picture then. So we've got about 3/4 of sectors in positive territory this morning across Europe. But at the bottom of the basket, we have basic resources. So they're down 0.6%. And this is what we expected, isn't it? Because we've seen the base metals falling after that China manufacturing data. A private survey, I should say, it's the Shein data, but at its lowest level in more than 2 years. And that hitting the likes of Anglo, their shares down 0.9%. Glencore, though, taking a beating, down 1.8%. Rio down 1.8%. Anto about the same as well. You talked about defence. If we turn to that sector, so Rheinmetall is up about as much as Tradegate was suggesting, so 1.2%. Also gains for Leonardo, BAE Systems, Safran, Airbus, all in the green, but Saab a little weaker this morning. What else should we be watching this morning, Anna?
Yeah, I'm actually just going to linger further on one thing you've already talked about, Lizzy, which is basic resources, because that is a real underperformance from that sector. Rio Tinto, Glencore, you can see coming through there on the Stocks Europe 50 performers as some of the worst performers, both of those down by more than 2%. And the sector as a whole is down by 1.3%. And it's one of there are only two sectors in negative territory, and that's quite a big movement to the downside. So as is often the case, that is the most direct read across from Chinese markets into what we see here in Europe. And we see a bit of weakness then coming through in basic resources. Financial services, the best performing sector, a fairly mixed bag of other performers this morning.
Yeah, Prosus was another one that I had said to mind, because the CIO, Irvin Tu, is stepping down, the Amsterdam tech investor, of course, but really not that much market reaction, only down 0.2% at the open. And the broader tech sector, really in the middle of the basket, up 0.1%. But let's get more analysis now. We can bring in Georges Debas, who is head of European equity derivative strategy over at BNP Paribas Markets 360. Lovely to have you with us round the table. I wonder if it's fair to say that the reason that not much is happening in this market this morning is because we're all a bit fatigued by all the tariff news.
Yes, I think it's a fair assumption, and it's also a function of where we currently are trading. So if we take a bit of a step back, the market has rallied back quite a lot. We are even pre-liberation days, even though there's more uncertainty and there's a bit more fatigue. So right now, I think investors and the market are taking a bit of a step back and say, okay, let's wait until we either have a bit more clarity around the trade negotiation or more clarity around fundamentals, because right now people are expecting either a weakness coming from earnings and also from growth, or a bit more of a stagflationary and inflationary. So we need to see where the data will take us, but in fairness, fatigue is very much part of the narrative also.
So we're waiting for the hard data, but we're also waiting for all these all-important deadlines, the 90-day deadlines, of course.
Correct.
How much upside is there left for European equities when we get some certainty?
Yes. So, listen, I'm also a bit of a student of the market. And if you look at the technicals, we're only 2% from the all-time highs in Europe. In order for us to reach that, it doesn't require quite a lot, because if you look under the hood, positioning is still light. So even though the market is back to almost the highs, the positioning and investors' allocation are still a bit more underweight than they were back in March, let's say. So on that metric on its own, you could have a continuous grind higher. But in order for us to breach new highs and create a new trend, we need to have this fundamental momentum. And in Europe, we have quite a positive and constructive narrative, basically with the fiscal stimulus coming. But we don't expect that to drip until H2 of this year. So it's going to take a bit of time. And right now, most, at least us and investors, are questioning what's going to happen this quarter.
Yeah.
And our corporate are going to wait, or going to invest, or are they going to restore the confidence as quickly as the market has seemed to have?
Yeah, you say we're not far in European stocks. We're not far from all-time highs.
Correct.
Should we, and you talk about the grind higher, maybe to those levels, should we not expect to go much higher than that? Should we expect George to go much higher than that, given what Europe is doing, what Germany in particular is doing in terms of fiscal spending, and everything we're hearing from the United States, things that are causing investors to pause when thinking about further exposure to the US? How much further has Europe to go, I suppose?
Well, I think there is what you call the tactical versus the strategic. On the strategic view, on the medium to long term, I think there's still more room to go. And if you look at where valuation are compared to history, we're currently trading at 50 percentile. So on that metric, we still have a bit more room to grow. And especially if we converge towards the divergence between the US and Europe, it's still quite a long way. However, tactically, on the short term, like I said, because positioning is relatively light, you could have a grind higher. But what we've seen over the past month is earning downgrades, because a lot of the positive constructive narrative in Europe is going to feed in later, whereas the tariff implication are a bit more short term. And that's what you're trying to mitigate, the short-term technicals versus the strategic, a bit more medium to long-term.
OK, and I wonder where you think we go on the America First trade. I received an invitation yesterday. It was not from BNP Paribas, from someone else, which was called From America First to Global Financial Anarchy. I mean, maybe that's a stretch.
Yes. But it's a nice one. I've never heard that before, but yeah.
But I wonder where you think, and maybe that's too binary, but I wonder where you think we land on investors' preference for America, speaking as people who are based in Europe and witnessing what we're seeing in the big, beautiful bill with this Section 899.
Yes. I think the Bill 899 or Section 899 is just another one of the many reasons why people or investors are rethinking their allocations globally. And if you've had a good decade or more where U.S. assets in general outperformed the rest of the world, which meant that investors, including Europeans, have over-allocated to the US. Now there's a bit of loss of confidence in the Trump administration, and there's also a bit more loss of confidence around the uncertainty that's stemming from all of these policies, which means that people are reallocating to other parts of the world, which have self-help story, like Europe, for instance, which is a very good candidate right now. So on that metric, if you look again, of all the inflows that the US have had compared to the rest of the world, there's still quite a long room for that trade to go.
Well, you mentioned the data. We're waiting for cracks in the hard data to impact US equities. What do those cracks need to be to stop this rebound?
We've
got the jobs data on Friday.
Correct. The job data, I think right now, it would be surprising if we have a very big crack. What we've seen today and yesterday are first signs of a slowdown in activity or uncertainty. But what we've learned from 2022, the surveys and the economy are not really working as they used to be. And so we just really need to see what the earnings is going to give us, which is in July as of now. And right now there's this wait and see what corporates are deciding to do. Look, if you're a CFO or a CEO of a large company and you have to steer the boat over the next 3 to 4 years, what matters is not the level of the tariff or what's coming in the bill. It's a certainty around what are your constraints that you need to work with over the next 3 to 4 years. And right now, there's no certainty around that. So that breeds a bit of loss of
and do the conversation, and when you're talking to clients about derivative strategy and about hedging, is it all about hedging for uncertainty? What is it about, George?
No, a lot less. It used to be pre-Liberation Day. Now, actually, we've restarted a bit of this conversation. But like I told you, many investors have already reduced a bit of their exposure, which means that the hedging is a bit less needed. But given that also volatility has receded a lot with the sentiment narrative a bit lower, what we're seeing and what we're telling investors is now is a good time to potentially hedge ahead of your summer and into potentially the end of next year. Or if you still have quite a large exposure to equity, use the lower volatility to do some what we call stock replacement. So it's a better way of allowing to have a beta exposure without actually a lot of downside.
Can I just flag what's been happening in the defence market since we've been talking? Actually, Rheinmetall, Saab and Leonardo have all turned into the red, which I think is interesting given, of course, we've got to factor in the Ukraine talks yesterday. But we did have the UK Strategic Defence Review giving a boost to UK defence stocks just yesterday. Do you think that was a bit of an overreaction? Because the Prime Minister's not committing hard to the 3% spending on defence.
Correct. It's all a question of also positioning and what's embedded in the price. If you look at the defense sector in Europe, it's up 25% as a sector over the 1 month, which is a very large number. So a lot of positivity is already baked into the numbers. We have been the structural buyers of the team, and we still think it's a very secular long. But ahead of the NATO summit or into this month, I think the risk-reward is if you have been long and you have had a hefty profit into these trades, maybe reducing a bit and waiting for, again, the trend to reaccelerate, just because expectations and valuations now are a bit overstretched. The fundamentals are not going to change. Strategically, we are going to spend more on defense over the next decades, however you slice and dice it. How you fund that is less important for equity investors. But again, what's in the price and what's positioning, and right now it's quite a consensus long. So that's where one has to be a bit more aware.
Could be more important for bond markets, though, couldn't it, than for equity investors. So just to finish the conversation then, George, I mean, you're bracing for lower. You think volatility goes lower from here in the second half of the year? Does the second half look less volatile?
I would say the second half of the year is potentially more volatile, but in the next month we could have a bit of less volatility until we get into the summer. The reason why we potentially could have a bit more of a volatile is because we expect in H2 of this year, that's when the US stagflationary environment starts breathing in. So the slower growth, higher inflation, and also if you look at Trump 1.0, if you look at the sentiment around tariff in general, they go through waves. And we had a peak of uncertainty. Now we're back in the low. Yeah. Most probably, if you use just that playbook, by H2 you will have a bit more volatility, again receding.
And in that stagflation environment, what's your assumption about the Fed's reaction function?
That's quite a difficult one. I think the Fed right now will have, I think as a BNP view in general, the Fed will have a lot more difficulties acting as long as the labor market is quite resilient. So as long as the labor market is resilient, their first mandate will be on inflation, and they will actually make sure that that's quite impact. If then it comes in balance, what we've learned from them, they're very data-driven, and they will take actions depending on that.
OK, George, thank you very much. Thanks for joining us. George Abbas, Head of European Equity Derivative Strategy at BNP Paribas Markets 360. Guy's not here, but his core six are still here. Let's have a look at what they are doing this morning, shall we? This is the picture, fairly mixed, actually, across some of these heavyweights in Europe. The biggest move we see on the screen there, Schneider Electric, which in fact features twice. In fact, a couple of them feature twice. Anyway, that's going higher, which is nice. Let's get the individual stocks on the move this morning. Joe Easton has a briefing. Joe.
So we are seeing some pretty significant moves lower in the mining stocks this morning, given that data that we saw out of China. Remember, it did show that the manufacturing gauge was in contraction, below 50, below the key number in the latest reading. So Glencore coming down 1.9%, Rio as well, similar amount, Anto, all of those slipping with the copper and also iron ore prices declining on that data. So clearly a bit of a feed-through into that one today. Then UBS, actually the best performer on the Stock 600 this morning after that rating change that we flagged earlier today. So that one up 3.6%. Now remember, UBS has this big update on Friday around the capital, how much capital they need to have on their books given the takeover of Credit Suisse a couple of years ago. And UBS is a buy at Jefferies, given they think potentially concerns around that event are overdone. So it's a nice move on that one. Pretty happy that that one moved higher after we had it in stocks to watch earlier. Then one stock not looking very happy at all is MJ Gleeson, down 26%. Pretty rough for that stock today. Remember, that is kind of more of a smaller cap home builder in the UK, warning that the housing market not recovering as much as they had hoped. This is more affordable housing in the north of England, in the Midlands as well. That one getting hit pretty hard. We did have some data showing yesterday around mortgage approvals not coming up as quick. Potentially that is playing into that as well, but more of a specific thing maybe for MJ Gleeson. Then staying in real estate, we have got a bit of M&A, not much M&A going on at the moment, but we have got Confinimo. I've probably got that one wrong on the pronunciation, but it does look like that one is around 3% higher. We've got Takeover. It's in the medical real estate sector, I'm told. So Confinimo getting a takeover bid. We did actually know this was going on. It was just a pricing that we've got on that, hence why the move in the stock not actually that big for that one, but Confinimo rising nonetheless today. And then finally finishing on the broker moves, ASMI, don't get confused with ASML, excuse me. Couldn't get those, get my ASMs right this morning, but that one up 1.7%. Barclays switching preferences. They like ASMI more than ASML because ASML has seen a drop down in orders. They prefer that one, and that one is gaining 1.8% in Amsterdam this morning.
All right, Joe Easton from our equities team, we thank you with your movers. 14 minutes into the session, the Stock 600 only up 0.1%, but it's green across the screen for European equities so far. We've been talking a lot on the programme about trade policy, the market reaction. We're going to dig into how it impacts businesses next. European regulators and retailers bracing for the impact of Trump's trade war with China. That's next. This is Bloomberg.
there's no question in the short term with what we've seen coming out of Washington and the political challenges of the trade negotiations, it's choppy.
We think we've got about a $500 million residual cost challenge as a result of those tariffs.
Since tariffs were announced on the 2nd of April and until the state of execution on April the 9th, we have seen some softening.
Things are steady, as we've been saying publicly for quite a while now, and we're reassured that our premium demand is holding.
And some of these events that we're seeing at the moment are short-term in nature. And therefore, they're not going to have a long-term impact.
They've got to just take stock and take a medium to long-term view as to what their costs are going to do, and then have a conversation with us as to what that may be.
Aviation industry executive speaking to Guy Johnson at the International Air Transport Association's meeting, the IATA meeting, taking place in New Delhi. Quite mixed movement on airline stocks this morning. They were talking there a lot about the availability of aircraft, the supply chains, that sort of thing, and other dynamics. But the trade conversation, though, Lizzy, no doubt very close to the minds of those airline executives. And with one eye on cargo, possibly wondering how many of those small packages are going to keep coming from China into Europe.
You lead me nicely to the issues that are happening for Temu and Shein at the moment. The Trump administration's trade war with China has really many European regulators and retailers scratching their heads, holding their heads in their hands and bracing for a flood of ultra-cheap Chinese goods. But this tide of products from e-commerce platforms like Shein and Temu may not yet be coming. For now, let's bring in Bloomberg's Sonia Vind, who's been writing all about this. Sonia, we've had Temu and Shein spending heavily in Europe, but are those efforts paying off yet?
Well, based on our reporting, we're seeing there's a real tension between what the platforms want and what the Chinese sellers on the platforms are doing. So Temu and Shein, they have pulled back on advertising spendment in the US and poured it into Europe. They are also offering to subsidize shipping costs into Europe. But that doesn't seem to be enough to convince these Chinese merchants. One merchant we talked to described entering Europe as entering hell mode. What he means by that is that Europe is very complex. It's a fragmented market with varying rules and regulations, multiple languages. So it's not as easy as the US market where things are more uniform. And initially, sellers did take a look at going into Europe, but they quickly realized it's not that simple. And with the US tariff reprieve, they were quick to prioritize the US market again and milk that market as long as they can.
OK, so Sonia, if the aim is to keep cheaper products out of Europe, and that might or might not be the aim, then it seems that the lack of common regulation and the lack of a real on-the-ground single market might be playing in that direction. How is Europe then preparing for a possible surge in cheap imports from China? Because I hear what you're saying about maybe it's harder to send those parcels into Europe than into the United States, but some in Europe must be concerned about what impact that might have.
Yes, definitely. And Europe is trying to get ahead of that because it's true Chinese sellers might be hesitant to push into Europe, but we've also seen a massive rise over the past years of low-value parcels coming into Europe. And the European Union and the UK needs to do something about that because many of these products are actually not compliant with the regulations and the rules. And it's also a pain for the local retailers who are complaining that it's unfair that they have to spend money and invest into complying with the rules, whereas many of the products that are coming in do not. An example are, for example, toys that exceed the legally allowed threshold for chemicals or laser pointers that are so strong that they could cause blindness. So European regulators, they have been ramping up the custom checks. They are investigating Temu and Shein over the sale of illegal products. And they are also considering to scrap the de minimis rule, something that the US has recently done. So there are various measures they are implementing, and it's yet to be seen how that will play out. But it's clear that at some point when the Chinese sellers might have to come into Europe because the trade tensions worsen again and it's just not profitable anymore to simply rely on that alone, then it's clear that the environment they'll be walking into here in Europe will be more tightly regulated.
OK, Sonia, thank you very much. Bloomberg, Sonia Vind with that interesting story around retail, global retail, Chinese retail, those small products and their way into Europe. Let's talk European politics then, Lizzy. We've had some headlines coming through.
Yeah, the far-right Dutch leader pulling out of the government, triggering its collapse. This, of course, is Geert Wilders. He'd threatened to quit if a majority of his party's proposals on migration were not adopted, and indeed he has. They had been struggling with these migration plans, failing to reach consensus. We'd spoken to Oliver Crook earlier about part of these plans, for example, being returning Syrians to Syria. They'd faced lots of legal headaches, concerns that the laws could put too much pressure on the legal system. And the talks were set to continue today, but here we have Wilders actually quitting because of the lack of progress. So you aren't seeing that much of a reaction when it comes to Dutch bonds, but we have seen the AEX dropping. It's now down 0.3%, straight off the back of this news, a real plunge in the Amsterdam index.
Yes, not hugely out of step with what we're seeing elsewhere on European markets, but yes, we do see some evidence of that response there. Let us pivot our attention to the global economy, though. The OECD has slashed its global economic forecast due to Donald Trump's trade policies, citing the impact of tariffs and uncertainty on confidence and investment. Bloomberg's Valerie Teitel joins us around the table. And Valerie, I take away from this chart, ably supplied by our colleague Dan Curtis, that the OECD has cut its growth expectations, its growth estimate, but it's still quite high. It's still an outlier.
It's still above at least the Bloomberg survey of economists' expectations. We have great tickers on the terminal for this that I watch very keenly. But the consensus estimate for 2025 U.S. growth at the moment is around 1.3. So what the OECD came out with recently is they're calling for 1.6. So it's still slightly above a consensus estimate. But look, it just goes to show that there has been, at least in the last, at the beginning of this year, there has been a very steep downgrade of what economists had penciled in for growth this year. You know, at the height of the excitement and euphoria around Trump's return to office, we were penciling in 2.2 percentage points of U.S. GDP. That's really been slashed, not in half, but taken a percentage point off that due to the trade war that was unleashed and all the uncertainty that was unleashed around the new administrations and the way that they're going about the tariff policy. But at least for me, and at least I think what the market cares about, is beginning to see upgrades to U.S. growth. Now that we have this tax bill, more certainty around the tax bill, more spending to come, fiscal spending to come that will keep the U.S. economy strong, and a lot of this uncertainty and kind of the worst fears about the trade war have kind of been put to bed. So I'm more interested to see if anyone is upgrading their U.S. GDP forecast on the back of that.
Feed that into the Treasury story then, Val, because as you've said earlier, that you saw the 30-year poking, I love that word, above 5%, but it's pretty calm in the Treasury market today.
Yeah, it is calm in the Treasury market today. Across really fixed income is really taking a big breather today, and that's nice to see. But maybe if we connect how the long end is trading, connecting that to global growth, better global growth means there is a higher term premium that should be baked into longer term yields. So I mean, you can read the rise in longer term yields in maybe a more positive spin, is that it's just pricing in maybe the effect of all this fiscal spending keeping U.S. growth okay.
OK, Valerie, thank you very much. Bloomberg's Valerie Teitel with another take on the bond markets and what we've seen there. And the latest from the OECD and their growth expectations. Coming up on the programme is European leveraged finance set to benefit from US uncertainty. We get Deutsche Bank's view. That's coming up next. This is Bloomberg. Welcome back. This is the opening trade. 30 minutes into today's session. And I was just about to say that we were making gains. I will say we were making gains at the very start of the trading day, but that didn't last long, did it? We're down by 0.3% on the stock 600. The FTSE 100 holding its head up a little better. And in fact, the FTSE MIB, so the periphery getting worse hit, down by 0.7% right now. So that optimism, such as it was at the start of trade, did not last long. US futures have continued to worsen just a little bit as the market tries to pass the latest closest lines on trade policy and the likelihood of any meeting, any conversation between Presidents Trump and Xi. That continues to be one of the big questions for markets. Let's pivot to leverage finance, though. Bankers are waiting for clarity from private equity firms, corporate borrowers and the Trump administration to move forward with deals. That's a read from the Goldman Sachs Leverage Finance Conference in California. Goldman's global head of credit finance, Christina Minnis, lent her perspective. Let's have a listen.
The cost of capital is higher, which puts a bit of a governor on the amount of debt. So the quantum of debt's a little bit lower. It's about a turn lower than it used to be. And so I think companies just have to be much more nimble and very thoughtful about how they manage their businesses, whether it's their CapEx plans or working capital. And yes, probably not taking that last quarter, half turn of leverage and thinking through putting a little bit more equity in.
Sticking with this theme, Deutsche Bank is set to hold its annual European Leverage Finance Conference here in London, bringing together more than 1,000 investors and issuers. Deutsche Bank's co-head of capital markets for EMEA, Hobie Bouvat, joins us now. Hobie, nice to speak to you. Thanks so much for coming to talk to us. So you're about to host this event, and clearly before then you can't know what the conclusions will be. But what kind of mood do you think participants will arrive at this event in? Within leverage finance markets, capital markets broadly, what is the mood right now?
Look, I think the mood is generally positive in Europe, I would say, as far as capital markets are concerned. What we have seen so far is recovery from global markets, obviously, after the heightened volatility we've seen, post-Tariffs announcement early April. And we've seen a recovery across asset classes. I think we've seen also rotation away from U.S. equities into the bond market, also into the leverage markets, also into European assets. So, we are hosting about 100 companies today. A lot of them are global companies, European-based.
Yeah.
And I would say that from an access to capital markets perspective, their sentiment is positive on the basis of what we're seeing, in markets.
OK, so expecting that positive sentiment to arrive with participants then at this event. But what about a lack of M&A and a lack of deal flow? Because that's sometimes the thing that drives companies to want to raise more money or can get bidders into the leverage finance market. So what's the link there? Break down the link between that part of capital markets and where that leaves your side.
Yes, I mean, absolutely. When we look at European leverage markets or global leverage markets, one of the greatest use of proceeds is acquisition finance, so LBO financing. What we've seen over the past few years, you're right, is that the proportion of acquisition finance into use of proceeds of financings has gone down tremendously. So it used to be around 60-70% acquisition finance driven, and now it's gone down to 30-20% even year to date.
So a decade low, I think you say.
So a decade low, absolutely. Why is that? The lack of deal making comes back to also the size of the LBO transactions and P activity in acquisition finance for leverage markets as well, and that has gone down materially, even though announced M&A volumes have gone up actually over the past couple of months. And there is a significant shift, actually, in terms of the LBO environment when you think about it. As Christina Minnis said, we have a higher interest rate and base rate, so cost of debt has gone up. That has had an impact on the amount of leverage that a company can take. You've also had a discontinued trend in terms of the multiple expansion that we've seen, in asset prices since 2021, 2020, after the post-COVID environment. That has also changed, quite materially, also based on where the base rates are, have been, and their impact on asset prices generally. And then the third thing is we've also entered an era of lower growth prospects. And so we've gone out of the sort of inflation-driven growth that we've seen post-COVID. And of course, we've always, tariff headlines. Yeah. There is definitely, a change in sentiment in terms of growth prospects across the world and in Europe.
So with that backdrop, what are kind of the underappreciated risks, shall we say, when it comes to European leverage finance? I mean, are there sectors in particular that you think present signs of stress at the moment?
Yes, this is a good point, because actually, as far as the markets have recovered, there is definitely pricing dispersion. And there is definitely sectors that have recovered better than others. So the more defensive sectors have recovered generally well. The more cyclical sectors, heavy industrials, autos sectors, and auto parts as well by extension, have underperformed, generally when you look at cash prices for, listed assets. So what we are hearing from investors, and this is one of the reasons we're having this conference today, we have about, 800 investors as well, is really to listen to, they have cash, the technicals are quite strong in the market, but we'd like to understand what are the sectors that they would like to buy and at what price. I think at the moment, there's still quite a lot of uncertainty around the impact of tariffs into earnings. And we haven't really seen that playing through in Q1. We think it's going to play through more in Q2 and probably more H2 of this year.
And where do you think you're going to see the greatest default risk mounting?
I mean, it's generally going to be around the sectors that will have the most impact from a raw material prices perspective, the ones that will have the most cost increase from a supply chain perspective. And then there will be some impact as well on consumer confidence. I think we've started seeing that, even if consumer spending has held up okay globally. I mean, there is definitely a change in consumer confidence and perception of discretionary spending. So the sectors that are the most impacted will be around, those ones.
And Hobie, you were talking about opportunities in Europe, and maybe that's been quite a theme of the last few months as investors have increasingly been looking at Europe, maybe less so at the United States because of a host of factors, not least of which policy-driven. But I wonder, we just got a reminder of the possibility of volatility in European politics this morning. The Dutch government has collapsed, migration talks failed, and as a result, the far-right lawmaker has left the coalition. How do investors think about political risk in Europe? We saw this in France, didn't we? And in some markets, that political risk really sticks, and in others, it doesn't seem to matter.
Yes, I mean, I think political risk is perceived by investors as just one of the risks, obviously, that are out there. There is a strong perception now in Europe of political will for more European autonomy. In terms of, we've seen on the defense side, on the infrastructure side, on the energy side. So as far as Europe's concerned, investors are buying into the political willingness, around countries and also at the European level. But you're right, the execution of this political will is really the key. And there are a lot of different things that have to happen, and a lot of the decisions will be made at country level, hence the importance of stability at country levels as well. But going back to, the French episode, for example, yes, we've gone through a time of heightened, premium for French risk. But overall, I wouldn't say that we've had a sustained, perceived weakness of France, and definitely not a desire from investors to not participate in sovereign issuances and also company issuances from that country.
OK, so really interesting, keeping the political uncertainty in mind. I just want to end, Hobie, with a comment that you made the last time that you were on Bloomberg. And you said that investment banks are going to need to work with private credit more to satisfy all of the needs of the new economy, the capital expenditure. How do you see that dynamic playing out? And is it happening at the pace that you expected?
Right. I think it is happening, and we're all part of a financial system and an ecosystem where everyone is playing a part. Definitely, there's been a lot of cash inflows, funds inflows into private credit, and those players have to deploy, this money that they've raised. And then, similarly, on the bank side, if I take our example on the defense side, for example, we do see a big role to play, in particular, in bringing some of the small and medium-sized enterprises into financing, their capex and their investment in order to supply the bigger OEMs, for example. So to answer your question, I would say, we will probably always want to move faster. The great thing is that, the needs are there. And that's also the feedback we're getting from companies that they would really like to have, a broader pool of capital markets in Europe, so public capital markets, supportive banks, as well as access to this, really increasing pool of private credit funds.
Okay, Hobie Bavat, who is co-head of capital markets for EMEA over at Deutsche Bank. It's lovely to have you with us around the table before your conference today. We wish you luck with that.
Yes, and we were just ending our conversation there with Hobie talking about private markets. So a nice opportunity to remind everybody that Kriti Gupta will be at the Super Return Private Equity event, which takes place in Berlin. We will be featuring a host of great conversations during Wednesday and Thursday's programming here on Opening Trade.
Coming up on the programme, Russia and Ukraine failed to reach agreement to end the war, but they do lay the groundwork for a new prisoner exchange. We'll bring you the details next. This is Bloomberg.
Welcome back to the opening trade, 8:45 here in London, so 45 minutes into our European session, which is showing some weakness. US futures haven't deteriorated much in the last 10 minutes or so, but they are weaker than they were at the start of this programme an hour and 45 minutes ago. So we're down by 0.5% on E-minis right now. Now, some of the political risk we're monitoring here in Europe is in focus. The Dutch coalition has collapsed after it failed to reach an agreement over far-right lawmaker Geert Wilders' Freedom Party's plan to curb migration. Oliver Crook joins us now to talk about the latest. So, Oliver, we have these headlines telling us that he's left the coalition. The coalition has collapsed then. So what's the latest detail?
So once again, the perennial issue in Dutch politics is this issue of migration. It's what triggered an election not too long ago that ousted Mark Rutte and then put the Freedom Party by Geert Wilders party into government after many, many, many months of coalition building. And this is a government that has stood now for less than 1 year, 11 months before its collapse, to be brought down again once more by this issue of immigration. What precipitated this was last week Geert Wilders put forward a 10-point plan on immigration. These points included using the military basically to guard the land borders of the Netherlands, turning away all asylum seekers, temporarily halting family reunification, also sending Syrians back to Syria, which he considers now a safe place for refugees and other migrants to be sent back. He said that if the majority of these 10 points are not agreed to by the government, yesterday he threatened to pull out of the government, and today, just a few minutes ago on X, we have him saying no signature for our asylum plans, no changes to the main outline agreement. PVV, the Freedom Party, leaves the coalition, and that is how we got the news this morning of the collapse now of the Dutch government. The next steps will be likely another election that will have to be called in the Netherlands. That was supposed to happen sort of by the term limit in 2027. That, of course, has now been accelerated with the fall of the government.
So, Wally, what are the implications then for the rest of Europe and the Netherlands' position in Europe after this?
Yeah, so very interestingly, I mean, listen, we just had an election in Poland in which you had basically this liberalizing force of Prime Minister Donald Tusk elected 2 years ago, trying to get his agenda through. It had basically been blocked by the former president and will continue to be blocked by the next president. And when you think about this from the sort of European and the perspective in Brussels, who is currently waging trade warfare with the United States, trying to show a sort of sign of solidarity, political stability, pro-EU, that is definitely not the sort of context that we get over the last 24 hours. In Poland, you basically have Donald Tusk, the pro-European, hamstrung in terms of getting his agenda through. And the Netherlands, which is going to host, by the way, in just 3 weeks' time in The Hague, a big NATO meeting that will be attended by Donald Trump, where all of these NATO countries are basically seemingly auditioning for continued participation of the United States. You want to project strength, you want to project stability, and that is not something you're going to be able to do, particularly when your host country's government just collapsed with many of the same themes that you've seen in the political disagreement in the United States and many of the sort of MAGA themes running in Dutch politics, in Polish politics, and of course politics in Germany, France, and elsewhere.
OK, Bloomberg's Oliver Crook, we thank you for the latest out of the Netherlands, the collapse of the Dutch government. And let's turn now to the geopolitics and dive more deeply into what that means for the rest of Europe. Because, of course, we already had Russia and Ukraine laying the groundwork for a new prisoner exchange yesterday. And that's after a second round of direct talks in Istanbul failed to bring the two sides together closer to ending the war. Now, these talks come as Prime Minister Keir Starmer's new defence policy aims to show the UK's commitment to being a key power in Europe and NATO, but the funding for those plans remains unclear. So there's a lot to thread together here, and I'm pleased to say joining us now is Rachel Ellehaus, who is Director General of the Royal United Services Institute, Rusi, and she was also previously the US Secretary of Defence's representative in Europe and Defence Advisor for the US mission in NATO, and she contributed to the UK's 2010 Strategic Defence and Security Review, so she really is a true expert. Rachel, it's great to have you with us on the programme this morning. Thinking back to that strike by Ukraine on Russia, the many strikes over the weekend, I just want to start there and ask to what extent they weakened Russia militarily or shifted its negotiating hand as we went into the talks in Istanbul yesterday. Is that perhaps why there wasn't a success? Oh, we're just struggling to hear Rachel here, but we will get back to her as soon as we can. Anna, it's a really fascinating moment for defence, of course, as we tie all of these threads together. I had wondered whether, the fact that Russia didn't want to agree to peace at this point was perhaps because Ukraine had been so strong into these talks and maybe it wanted to wait for a moment when Ukraine was weaker. Let's try and get back to Rachel Ellehaus, the Rusi Director General now. Rachel, can you hear me?
Yes, I can.
Perfect. What's your answer to that question? Is this strike perhaps a reason why we didn't get closer to peace yesterday in Istanbul?
The strike is a really great example of how Ukraine has performed throughout this conflict. They've always contained an element of surprise. They've always innovated. They cannot outmatch Russia en masse, but certainly when it comes to innovation and creativity, they have used those things to their advantage to gain the upper hand. So I wouldn't link that with the failure or success of the talks, because in my view, the problem with the talks is from the outset, they haven't included all parties and they haven't held Russia to account for its role in this war.
Do you think that's something that the US administration is going to do, Rachel? Good morning. Good
morning. I believe they're slowly coming to the realization that any sort of sustainable ceasefire or agreement must take account Ukraine's views, the views of Europeans who are alongside the conflict. But it's been a long time going, and Ukraine has to continue to assert its agency in this fight and its demands, as do European countries, in order to be heard.
Well, we had, of course, the Strategic Defence Review out of the UK yesterday. A lot of money being spent on heavy weaponry. But when you think about what happened in Russia by Ukraine over the weekend with these $200 drones taking out heavy weaponry, does that suggest that maybe the money is being misallocated or just the vulnerability of these big, expensive assets in modern warfare?
It's important that the review has a balance of both mass in terms of people and capabilities, but also a focus on innovation. Again, if we take the example of Ukraine, they've really shown how you take those more conventional capabilities and forces and you pair them with unmanned systems, satellite communications, the element of surprise. So I took the defense review as a move in the right direction because it does have a clear focus on transformation.
Yeah, move in the right direction, Rachel, but is there enough money behind it? 3% has become the new target, and others talking about whether it should actually be 3.5% as we move towards that NATO meeting later on this month. How important is that kind of detail? How do you project strength when these conversations are all about 0.5% of GDP?
You're correct that the NATO ambition, as we anticipated for the Hague summit, is 5%, with 3.5% excuse me, of that going towards core defense spending. And so even 3% by 2034, as the review anticipates, will fall short of that. That having been said, I think we do need to look at the quality of the spending. We need to make sure that every year there is a real term increase in spending. So while it's probably not as much near-term cash and uplift as many had anticipated, it is a step, again, in the right direction. And if that money and that increase in spending can be paired with a sustainable plan that makes cuts where needed and strategic investments to get that innovation edge, then I think we can be relatively optimistic.
What about the investment in nuclear deterrence, Rachel? Because we've reported that the UK is planning to take an enhanced role in NATO on that front. Do you see that capability being necessary in the near term? And if so, under what circumstances?
Certainly, given Putin's careless use of messaging his intent to use nuclear weapons, in particular tactical nuclear weapons, I think the UK, the US, and France having a safe, capable, modernized, responsibly managed nuclear deterrent is absolutely important. It is a very expensive capability, and it does take up a lot of the defense budget. So controlling those costs while getting the maximum effect in terms of messaging towards the Russians is going to be very important. And working together with the United States and France to use that messaging together to send that signal.
Yes, Rachel, if I could broaden the conversation, picking up there on what you said about working with the United States, given the extent of your experience on both sides of the Atlantic, how do you assess the US reaction to any attack on a NATO ally right now? How much has it really changed since years gone by? I was reminded recently that European leaders have often had doubts about whether the US would really respond, from Adenauer to de Gaulle. What's your assessment of the US response?
I think we are seeing an evolution in the U.S. thinking. A number of U.S. Leaders in the current administration have signaled a desire to lead from behind when it comes to Europe. That's due both to a sense that we've got more pressing problems in the United States that have to be addressed, as well as a desire to be more active in the Indo-Pacific. That having been said, I think Europeans have shown that they're willing to step up and spend more in defense and take on more responsibility within their own theater. I was really pleased to see a NATO first approach in the Strategic Defense Review, because the UK is a very important partner in making sure that security and defense in Europe is really solid and taken care of, in particular if the United States does step back from that leadership role in the alliance. But for the time being, the United States nuclear deterrent is still extended under that NATO umbrella. U.S. forces remain in Europe. U.S. leadership continue to talk about the importance of NATO. And even more importantly, the U.S. Congress and public are firmly behind the alliance.
OK, Rachel, thank you very much. Rusi Director General Rachel Ellehaus, we thank you for your time. Quick reminder then, Lizzy, some of the data points we're watching out for today. We get Euro area CPI, which is expected to come down just ahead of that ECB meeting.
That's no more inflation problem for Europe, it would seem. If
2% or below,
Yeah, reflect that. And then they can cut on Thursday, and then it's, do they cut again? That's the question.
And then we'll get US durable goods later on today. We get US jolts. We've talked a little bit about that coming before the non-farm payrolls data. That is it for the opening trade. The pulse is up next. European stocks just on the back foot a little. US futures pointing 0.5% to the downside this Tuesday morning. This is Bloomberg.